So you've held on to an investment for a while, and now that investment has gone up significantly, and you're sitting on a massive amount of unrealized capital gains. What do? Do you simply continue to ride it out and avoid paying capital gains? Or do you take some profits off the table? We're breaking it all down in this week's episode. You don't want to miss it. Hey everyone, this is John Boyd, host of the Emerging Wealth Podcast. Thanks for joining us and making us a part of your week. Before we dive in, if you're finding value in our content, please give us a like. This helps us reach more listeners and share quality financial education. Next, I'd recommend visiting our website at www.modernwealth.com. Head on over to our learning center. It's packed with videos and articles designed to help you optimize your wealth. While you're there, consider subscribing to our newsletter. Thanks again for being with us. Now let's dive into this week's episode. Welcome to another episode of the Emerging Wealth Podcast. As always, we got a good one for you. We're breaking down buy and hold versus taking a profit with your investments. The inspiration for this episode, and a big reason why I wanted to do it, is because I've received a handful of emails from clients of ours over the last month, really asking what they should do with a handful of investments as we get closer to the end of the year. Everything from individual stocks to even cryptocurrency has gone up pretty significantly this year. And as a result, there's a lot of people out there sitting on pretty large unrealized capital gains. And so the $1 million question that a lot of people want to know is, what do you do when you're sitting on all these gains? Well, that's exactly what we're going to break down today. So here's the reality, and it might be a harsh wake-up call to a lot of people. If you have to ask yourself when to sell an investment that has gone up significantly, you've already messed up. And the reason being is that when you invest in something, you need to have an entry strategy and a reason for it, and an exit strategy and a reason for that. What I find with most investors is that people tend to have an entry strategy, and they're usually pretty fired up about that entry strategy. If you were to ask somebody why they invested in a particular investment, they'll usually give you a good reason for it. But the moment that you ask them, well, what's your exit strategy for that particular investment? It's crickets. They have no idea what to do. A great example of this that I've seen a lot are with people who follow stock newsletters. These newsletters recommend stocks to people. They buy them, but then these newsletters never tell you when to exit. So people just end up buying and holding these individual stocks with zero exit strategy. Another good example of this is with company stocks. Maybe you get RSUs or you participate in an ESPP and your company stock has gone up a ton, but then you have no idea what to do. And people never have a strategy to actually lock in any profit. So you get the idea. People generally have a lot of conviction and rationale as to why they want to purchase an investment, and generally have some sort of entry strategy, but generally have zero strategy to actually maximize profit. If they did have an exit strategy, then the question as to when to take profits is a lot easier. And I will give you an example of that. So I've had clients in the past tell me they're personally very bullish on cryptocurrencies and want to have Bitcoin in their portfolio. They're extremely convicted in this and want to buy crypto. If that's what they want to do, my general guidance for extremely aggressive investments like cryptocurrency, venture capital, certain individual stocks, angel investing, whatever it may be, right? Something super aggressive. I tell clients this. A, you got to have the mentality that you're okay losing your initial investment. B, once you are okay with this mentality, keep that investment to generally no more than 5 to 10% of your liquid portfolio. And what we'll do from here is agree on what that initial investment should look like and what our exit percentage is. So what did we just do here? We established an entry strategy and we established an exit strategy. Now fast forward to today. Bitcoin, as of the recording of this episode, is up 160% year to date. Now, this client that allocated to, let's say, Bitcoin for a small, aggressive portion of their portfolio that, let's say, was initially 5% of their overall liquid portfolio has now grown to 15%. So if this is the case here, right, the question as to whether we should buy and hold or take profits is pretty straightforward, right? We would go ahead and just simply take profits. And the reason for this is that we don't want to have this investment be any more than 5 to 10% of the overall portfolio, and it's now at 15. We're just going to go ahead and trim it down and take some profits off the table. I mean, it really is that simple. And it's a big reason why having a cohesive and definitive investment plan that illustrates what should be in your portfolio and how much of it should be there is so important. Because if you know this, it's very easy to answer these type of questions. Now, I know what some of you are already thinking. Well, John, if I sell, I'm going to get hit with taxes. I don't want to sell and get hit with a ton of taxes. That's an extremely valid point. We used a more extreme example here with Bitcoin, but let's just assume we were talking about exposure to the S&P 500, small cap companies, right? Some broadly diversified index, whatever it may be. Ideally, you want to take those profits once they have qualified for long-term capital gains treatment. But even if you qualify for long-term capital gains, for most people, that's 15% going out the door in taxes. Now, even if this is the case, I would encourage you not to let the tax tail wag the dog too much. Yes, taxes are important when managing a portfolio, no doubt about it. But also, you don't want to abandon ship on rebalancing your portfolio or taking profits off the table just because you're scared of taking a tax hit. Now, if taking a profit is ultimately a good thing, why do people advocate for buy and hold strategies? Well, buy and hold approaches to investing work well when you are dollar cost averaging into a broadly diversified portfolio and you have money constantly coming in. Great example of this is with your 401k. Your 401k could be in something like a target date fund. With every paycheck, you're going to have money that goes into it. In this example, or with this type of investing, buy and hold works really well because you are just simply going to buy more of a super diversified investment with every paycheck. And you don't really need to worry about trimming profits until perhaps decades down the road. But even with this approach, you have an entry plan. You're just simply going to buy more of it. And then your exit plan is to simply trim decades down the road when you retire. You're buying and holding for a long time, but there technically is some sort of exit plan. Now, again, buy and hold works really, really well when you have a broadly diversified portfolio and there's constantly money coming in. But where buy and hold doesn't work well is really in two key scenarios. Number one, when you aren't adding money to a portfolio and you have allocated percentages to investments you want. So let's say that you want to have 50% to the S&P 500, 20% to small cap, and 30% to international. If you are adding money constantly to a portfolio, it's easier to stick to those percentages because you're just simply going to buy more of those investments and you're going to bring the portfolio to balance when you do. So you're in essence taking a buy and hold approach. You're just going to buy more of the investments and hold them. But if you aren't adding to the portfolio, then your original percentages are going to be all out of whack eventually. For example, if the S&P 500 is now 60% of the portfolio when it was supposed to be 50%, it's probably time to trim 10% and add that money to an area of the portfolio that is below its target percentage. That's what rebalancing a portfolio is. It's simply taking profits and buying cheaper assets in the portfolio. In a nutshell, it's buy low, sell high. The other scenario where buy and hold doesn't work extremely effective is when people try to apply the same approach to something like their company stock or a more risky investment. With individual stocks, or let's say a company stock, there's no guarantee that all those gains that you're sitting on are going to be there in the future. With something like the S&P 500 or broadly diversified investments, the general belief is that they may go up and down, but they eventually go up over the long run. That isn't necessarily the case for an individual stock or a more risky investment. That is why having an exit plan for these type of investments might be even more important than your other investments. Because if you mess up the timing of trimming profits with, let's say, the S&P 500, it's not necessarily the end of the world as long as you have a very long investment time horizon. But with, let's say, your company stock that's at an all-time high, there's zero guarantee your company stock will ever be at that price again. Now, with all this being said, one factor that you need to be aware of that is an inherent part of human nature is greed. Investors get greedy. If you have ever thought, well, what if I sell and take a big profit, but that investment keeps going up? If you have thought that, that's the greed element. This is why I find a lot of people are bad at rebalancing their portfolios or just taking profit off the table because they just want to keep letting their winners ride. This is why your average investor is generally bad at investing at individual stocks or riskier investments because they don't know when to exit. It's very easy to log in on their phones, on their favorite investment app, and see all that green and those big positive percentages showing how much you're up on an investment and just stay. Right? It becomes psychologically tough to leave. But you gotta be stronger than that. And that is why having a dialed in investment strategy is so important. Because if you have a dialed in investment plan that outlines what your entry points are and what your exit points are for certain investments, it's easier to ignore that greed element. It's easier to take profits off the table when appropriate. It's easier to buy and hold when appropriate because you have a strategy that has mapped this all out. As a reminder, everything on today's podcast was general education only and not deemed to be specific investment, tax, or legal advice. If you need specific guidance, you can reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. It's been a lot of fun, guys, and I'll see you next time.